Hey everybody, welcome back to the Optometry Money Podcast. We're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening today. Appreciate your time and attention. And on today's episode, I am joined by Jackson Pace and Kevin Dang, CPAs of Refractional CFO. And we dive into a really common question that we hear from OD practice owners. And that's, if you're planning to buy a vehicle, should you purchase it under the name of the practice so that you can depreciate it and get that tax deduction? So how do we handle vehicles in your business? We talk about what is required for a business to own a vehicle and to take a tax deduction for that. We talk a lot about actual business use of your vehicle versus personal use. We talk about the basics of how depreciation works. Should or shouldn't you accelerate it versus take it over a standard schedule? Then we talk about non-tax considerations for owning a vehicle that's especially a personal vehicle in the name of the business. So we give you a lot of information to help you talk with your own tax professionals and to come to informed, educated decisions on what to do with this. Reach out to me or Kevin and Jackson if you have any questions on any of this. You can check out all the resources we mentioned here in the show notes, which you'll find at the Education Hub at my website, www.optometrywealth.com. While you're there, check out all of the other articles and resources and episodes we've done. And you can also schedule a no-commitment introductory call. We can talk about what's on your mind financially and how we serve optometrists to navigate those same decisions all over the country. Without further ado, here is my conversation with Jackson Pace and Kevin Day. Welcome back to the Optometry Money Podcast. I'm Evon Mendrin, your host, and I am excited to welcome back to the podcast Mr. Jackson Pace and Mr. Kevin Dang, CPAs at Refractional CFO. Thanks for coming back on.
Yeah, no, thanks for having us, Evon. Always a pleasure to be on the podcast.
I'm excited to talk about what I feel is a topic that's commonly asked about. You know, the three of us are inside of a lot of the same online optometry communities, and we see the questions that are asked. And a lot of the times I feel like, at least over the last 6 months or so, I feel like a question that's come up consistently is you have a practice owner, they're planning to buy a new car, and they're asking the group, hey, can I or should I buy this car in the name of the practice for the purpose of depreciating and getting another tax deduction? And, you know, I look through the tax returns of my clients, and it's not uncommon that we get to the practice tax return and you see, you know, a Tesla on there, 100% business use, you know, so you kind of start to see that on tax returns a little bit. I'm sure you guys get asked about this a lot and see that a lot, maybe with past or current tax returns. So I want to dive into this topic and kind of get down to the core of it, the actual facts, the matter to say, can and should an optometry practice owner purchase the vehicle in the name of the practice and for the purposes of taking that depreciation as a tax deduction? So let's just start with some of the basics. What are the basic requirements? What's needed for a practice or any business to own a vehicle and to take that depreciation as a tax deduction? What are some of the general requirements?
Yeah, I can touch on this one just a little bit. So with a vehicle, they're really just like any other qualified business expense. So sometimes they stand out because there's, for whatever reason, there's usually a lot of confusion maybe around vehicles and can the practice own them? How does the practice actually expense a vehicle? We even get questions around, do we have to wrap our vehicle in advertisements to be able to do this? Or so for whatever reason, we come into a lot of issues around the clarity of, is it a qualified business expense? And so the first hurdle that we have to get over is that question exactly. Like, is it a qualified business expense in the practice? And so as you look at your practice, you know, especially maybe you're listening to this podcast right now and you're kind of at that crossroad of needing a new vehicle and you know, we're getting toward the end of the year, fourth quarter. And a lot of times this is when we start doing tax planning. Maybe you're looking at your financial statements and seeing that you've just had a really good year and you have a lot of income, which means your net income is up, which means your potential tax liability is up. And so we hit these crossroads, and it's like, should we now purchase a vehicle, and does it make sense to do in the practice? And so as we answer that question, just kind of think through the needs of the practice. Obviously, if you're maybe the optometrist, you own your practice, maybe you are an independent optometrist doing 1099 work for multiple practices, or maybe you have a need with your staff members. We've seen some practices from time to time, they'll purchase vehicles for the practice specifically for the purposes of being a courier, which means they have a full retail optical. They have patients that are coming and going. And one of the benefits that they provide their patients is when their glasses are done, they're actually going to have one of their employees. Yeah, think of it like the Uber of the optical world. One of the employees hops in the vehicle. They take those glasses from the practice right to the patient's house. They help them try it on. And like in my mind, that's like the coolest experience. Like I wish I just had glasses that would show up magically at my doorstep. But as we think through that scenario, I don't think anybody listening to this podcast would question, absolutely, that's a business expense. We're having our employees hop in the vehicle, drive it down to the patient. And so some of these scenarios are pretty black and white. Like in that one, that's definitely a business expense. Now, kind of get back into the mindset of we're the owner, we have the practice, what happens if I have to get in my vehicle? It kind of depends now on what we're doing with the vehicle. So if you're purchasing this vehicle and you just use it to take your family on vacations, go to sports games, run the kids around, do that type of stuff, it's not really a business related purpose. Taking your family on vacation, even though it's fun, maybe you can kind of squeeze a CE conference in there to maybe get this into the business realm that expands. But there's a lot of times that we're just using the vehicle for personal reasons. And so for most of our practices and most of the doctors that we work with, what ends up happening is we have a vehicle, and part of it's going to be used for business use, part of it's going to be used for personal use. And so now comes into the equation, well, how does that work? And as we get into our tax return and as we actually book some of these expenses, make QuickBooks, like how do we do this? So maybe Kevin, do you want to kind of go into just kind of maybe more the technical details of how we actually do this?
Yeah. So let's break the one question down to two part, right? How do we own a vehicle through the business, and how we deduct the expense, right? And sometimes those two things does not equal to each other. So let's talk about ownership first. A lot of time we get the question, okay, do I buy a vehicle through the business, or should I buy it under my own name, right? Well, if it was like a straight cash deal, so yes, you can buy it from the business, right, from the business bank account. However, if you go out and buy a car, and most of the time you would have some financing with the car, you get a loan from the dealer or from the car salesman. So in that case, maybe not be so practical that the car going to be under the business name, because most of the time car salesmen don't like the car with a loan be under an LLC, right? What happens if you default on that loan? They can't really kind of get recoup all of that, right? They can recoup the car, but by that time they sell out the car, they may get paid less than the amount of the loan that you have on the LLC. So in that case, most of the time you have to buy the car under your name, right? In the real world, that's what people do. So in that case, it's really hard to own the car under the business if you have a car loan. Well, what we do is we say, hey, you buying that car with the loan, you contribute the car along with the loan to the company, so the bookkeeper may record the car and they also recognize the loan. Or if it's just a straight cash deal, that would be really simple, right? The cash is reduced from the bank account and we recorded the car in the balance sheet. Okay. Now, we already talked about the ownership, right? Between either buying from the business or buying from under your own name and then contribute it to the business. Well, but ownership doesn't mean that you can get to deduct the expense or depreciate the whole car, right? You may record it a car of $100,000, on the book, but the next question is the use of the car, and the use of the car is what get you the deduction, right? We have to look into the fact. Then the IRS would ask, what is the percentage that you are using that car for the personal purposes versus the business purposes, right? And we have to look at fact and circumstances. In the example that Jackson have, is somebody have a car that solely used for the business, and that is 100% of the business, then we can, depreciate the whole car, right? Obviously, there would be limitation on the amount of depreciation each year that you can take. You may have to spread it over the year because of the limitation. But if your business, you only use the car, let's say for 70% of time, that for the business, and 30% of time you use for personal purposes, then you can only depreciation. You can only take depreciation on 70% of the cost basis of the car of 100,000, right? And so that, and then in the daily use, you have to think about what are the expense for the personal use and what are the expense for the business use, just like any other business expense versus the personal expenses that we have. And I hope, that answered the question on how we report and deduct the depreciation.
Yeah, I mean, that's a great point on the financing issue. At a minimum, it may very well just make it more expensive to get financing if you need to through the business rather than individually. But if you're unable to get financing, perhaps maybe your business is too new, relatively new, then you'd have to do sort of this workaround, buying it individually and then contributing it to the practice as an asset. And a lot of it seems to come down to use, right? Just like anything else, are you using the vehicle for business use, or is it in reality a personal vehicle? And a lot of the times, especially when you kind of read a lot of these questions or a lot of the answers to these questions, it's quite clear it's not a business vehicle. And in fact, it's explicitly stated it's a personal use vehicle. So it does come down to business use. And let's talk a little bit more about business use. Jackson gave a perfect example of one I've actually not seen before, of clear, absolute business use. Really cool, creative way to use a vehicle in the business. What are some other ways to use the vehicle? For example, is driving from home to the practice considered business use? Is it from the practice to the bank? Like what are some of the ways that outside of that kind of creative use would be considered business use?
Yeah. So there's obviously, the example that I gave is I don't know, you'd call it an extreme example. In my mind, it's a really good example because, it just goes to illustrate the need that practice can have in getting glasses. So, that's one use scenario. The other one is if you're a practice, you have employees that are using their vehicle. Sometimes that comes into play. Like how do we treat their vehicles? If we're focused more just on maybe the owner, their vehicle, and what constitutes, a couple things. One, a lot of times doctors are on call, so a lot of times they have to have a vehicle to be able to get back and forth from the practice. The other thing that we have to consider, and the IRS kind of looks at this through the lens of where are you actually doing the work in your practice? For a lot of the clients that I work with, they have a dedicated office in their home. That's kind of their primary office for the practice. They don't have a separate office inside their building. I mean, when we look at how precious real estate is anymore and how expensive it can be, sometimes it just doesn't make sense to build out a nice big office that you can do a lot of the paperwork and the administrative work in a practice at your actual retail location. We're a little more wise in the way that we design it. Maybe we make the optical a little bit bigger. But usually what ends up happening is now we have really the back office of the practice is happening in your home. So we have these instances where we have to get from more or less the headquarters of the practice, which is at your home, to maybe the actual practice location, or maybe we have to say on a weekend, we're running around doing errands. We got to go pick up stuff for the practice. So if you think through these different types of trips that you're taking, you have to think through it. Is this a business related trip that I'm taking? Is this a personal related trip? And the nice thing about this is there's lots of apps out there that help us just make this a little bit easier. Because if we had to end every day by taking out a paper and pen and writing down in a notebook, I drove when I got into my vehicle in the morning, the odometer was, 1,000 miles. And at the end of the day, it was 1,034 miles. And, the breakdown of this 34 miles was such that, this thing was personal and then this breakdown was business. Nobody even want that headache. Right. And so what we can do is through the use of some of these different apps is we can start to track these trips. And so it goes back into, maybe to build on a little bit with what Evon was talking about on how we actually depreciate these vehicles in the practice. One scenario is the practice can more or less own the vehicle. We depreciate that. And that's just a way of expensing the cost of that vehicle over time. The other way is we can keep track of the mileage. So in the year 2024, right now, the IRS, they come out and every year they set a standard mileage rate. So for this year, every mile that you drive your vehicle, you can actually reimburse yourself 67 cents per mile. So a common question, and usually when I have people calling me, asking me about vehicles, really what they're trying to figure out is how can I cover the loan payment by, basically how can the practice cover the loan payment more or less? So they're not too worried about, is this going to be an asset of the practice? Is this going to be a personal project? They just want to go out. They want to purchase a vehicle and they just want some help. They want to be able to pull some money out of the practice and to be able to make that payment. So sometimes the easier way to go about this is track your mileage. So say maybe over the course of a month, if you drive 1,000 miles, that's $670 that you get to reimburse yourself for the use of that vehicle. If you drive 2,000 miles, that's $1,340 that you get to reimburse yourself. And the nice thing about these reimbursements is they come back to you tax-free. So it's not like the practice is going to write you a check for $1,300 and now you got to pick that up as income. That's a reimbursement for the use of that personal vehicle. So you kind of get the best of both worlds. It's an expense on the practice side, but it's also money into your personal bank account that now you can go and make that loan payment. If that's kind of the goal they're trying to achieve. With that, anything you want to add to that, Kevin, as far as hopefully I didn't misspeak anywhere and give anybody
everything comes down to fact and circumstances, right? So let's breaking down. Fundamentally, the IRS say what is a business expenses, and it's being defined as ordinary and necessary, right? Now, ordinary means something incur frequently and also not out of the norm, right? If you say it's ordinary is versus non-ordinary. So remember, it has to be kind of reasonable, right? Making sure that you are not so stepping out of the zone, stepping out of the norm by so much, right? Would a reasonable person think that the thing that you're doing are reasonable, right? Necessary mean is this kind of necessary for your business or it's not necessary, right? Is this just something that your business need, or is just something that out of vanity that you have, or your hobby that you're doing this? So, you can be creative if you have an office with lab or Azure at home, and you need to run back and forth between the practice and the room at home that you use for equipment and for the Azure, and that would be ordinary and necessary, right? But if it was like a run to grab a drink with some friend or going playing golf, now that would not be ordinary or necessary for your business. So just sit down and take a deep breath and think about facts and circumstances. There are ways to make it work, depends on your need. So
interesting. And so it seems in terms of the requirements, the business has to own the vehicle in some way, whether it's purchased by the practice or contributed into the business. The other part of it is what we've been talking about is business use, and some percentage, some high percentage of business use. And is there a point to where the business use is too low? For example, if it's dropping under 50%, like does the percentage of business use impact it? And if so, in what way?
Right. So, let's first talk about depreciation. There are two parts. If you take the actual expense, and if you do depreciation, that means you depreciate the car. And then for any following years, you take the actual expenses, right? Maintenance, you go out and pay for the gas. That's the actual method, right? With the depreciation, if you take 179, the business yield has to be above 50% of the time is the business yield. Then you take 179. Now, the bonus depreciation doesn't have that kind of limit, right? So no percentage on the business yield that can take the bonus depreciation. Obviously, you can only take the percentage of the business used for depreciation, like I mentioned. But if you have like 20% of the business used for the car of 100,000, then you can take the bonus on that 20,000, right, portion for the bonus. Now, 179, it has to be above 50% of the business used for 179. Now, 179 is still here strongly, it's still going on. Bonus depreciation is phasing out. This year is 60% bonus depreciation, right? Let's say, in my example, let's say the car is 100,000, you only use 20% of the car, right? Then you can depreciation 20%. You can depreciate 20% of that 100,000, which is 20,000. But the first year limit is 60% of that. That's been $12,000, right? Then, if you use like actual expenses, then you have to think, okay, if I pay for the gas and my gas bill is $100 to fill up my tank, and I only use like 30% of that on the drive that for the business, then I deduct 30% of that, right? Which can get pretty complicated in real life just to try to split out all of those receipts. Right? So maybe perhaps the easier way is to use the mileage, right? And with the mileage, then you don't take the depreciation. You just say you track the mileage and time that by the rate of 67 cents a mile in the year 2024. And with the mileage tracking, you don't do depreciation. You don't have to keep the receipt, right? So, in theory, you have to do a certain thing, but in real life, perhaps it's easier to use the standard mileage if you commingle between business use and personal use.
That's not as exciting, Kevin. That's not a tax savvy strategy you'd see on TikTok.
Right. Well, in the past, car use has been always one of the point that likely increase your audit risk, right? And Jackson and I, when we give advice to the client, we normally give advice of what is, in theory, what is being required versus what is actually being done, right? For example, a lot of client has come into us and ask, okay, if I use mileage or use car in the business, would that increase the risk of me being audited, right? And we would give, list out all the guidances, and they can choose between the actual method versus the mileage, right? And also, we, here is some interesting statistic that hopefully, gonna have to expand some of the next conversation that we're gonna have. So since 2011 to 2019, right? The risk of an S corporation, if you have an LLC filing tax as an S corporation, the audit risk is 0.1%. Pretty low, right? That's a pretty low audit rate, right? Now, if you are a sole proprietor and you file tax as a Schedule C, right? If you make the income under 100,000, the audit rate is 0.9%. Still pretty low, but that is 9 times more of a likelihood of being audited than an
That's
S
actually
corporation.
surprising to me.
Right?
That's interesting.
Right. Now, if you're filing tax as a Schedule C and you're making from $100,000 to $200,000, the audit rate is 2.4%. So that's 24 times higher than the audit rate of an S corporation. 24 times. If you're making $200,000 or more and filing tax as a Schedule C, your chance of being audited is 1.9%. So that's 19% time, more than an S corporation, right? So, if you have like a car or taking mileage under the Schedule C, that will be pretty high risk if you're in that realm, right? But if you're in an S corporation and take the deduction of the car and the mileages, you are less likely to be audited. Well, I don't know if because of the car issue or just because of the structure. Like I said, the S corporation being audited is so low versus a sole proprietorship. Filing tax as a Schedule C have 24 times more of an audit risk in some case, right? So, if you were you are a sole proprietorship and filing tax as a Schedule C, I have to watch out and I have to give more advice and say, hey, be a lot more careful taking the car depreciation and the car expenses and the mileage versus an S corporation as a whole, right? And I think, we talk about, in real life, how people doing it, and the tax structure is also affect that, right? That risk of being audited.
Which is fascinating. And I think a lot of practice owners would hear those low percentages and start to get some ideas, right? Ultimately, you can put whatever you want on your tax return. And until you get called out for it, you don't have to defend it. But if you do get the letter from the IRS, or if you do get a notice that you're going to have an audit, then you have to defend it. And ultimately, I'm sure there are costs and time and frustration with going through an audit, but even if you are audited, if it's legitimate and substantiated, then you don't really have to worry about it. And I mean, I'm not the tax professional here. I am curious to know your perspective on that. But if it comes down to it and it's not substantiated, well, then you have to defend it. If you are the unlucky one, then you have to go through the responsibility with your tax professional or pay a tax professional to help you through it and try to defend that. Have you been through that experience? Exactly. I mean, what has that been like for you?
Yeah, I mean, being audited by the IRS is not the most pleasurable experience. It's really difficult to go back to the record, and you have to keep really good record to substantiate those expenses. And a requirement of car, the use of the car is, for mileage tracking, it's you tracking the mileage. You have to have the mileage log. And that's why, we've been recommending people to keep track of the mileage. Now, we talk about in theory and how to defend in the case of audit. Then let's switch back and talk in real life how people do it. Right? I have seen clients who come to me and say, I don't keep track of the mileage log. I kind of calculate out the number of miles that I drive a week, and then can I time that by 52 weeks in a year and get the mileage, right? Obviously, you are required by the IRS to keep track of the log, but in practice, that can, be proven to be a challenge for our client, right? And we try to think, okay, we know that we have to keep track of the mileage logs in case of an audit, but what is the chance of you being audited, right? What is the result and the risk of you being audited? What is the fine and the penalty and the increase of tax, right? If your estimate is really close to the actual mileage you're driving, perhaps that won't be too bad, right? The IRS may assess you some additional tax, but that amount can be small. Versus if you take a really unreasonable amount of mileage, really high, then that would create a higher tax bill, a higher penalty. And we are in a business world, so we want to take a look at things as based on what is the risk, right? What is the cost and what are the risk versus the benefit. So I think for myself as a professional, obviously we want to have the client to follow the rule as best as they can, but a lot of time has been proven to be a challenge.
And I might just add, as we think about this, just be smart about it. If you only have one vehicle and you're claiming on your tax return that vehicle is 100% business use, every time the IRS comes in and looks at that, they're going to say, well, what vehicle did you use for personal use? And then they're going to kind of just catch you with this, well, yeah, never mind, I did that wrong, So, if you're going to do it, not saying that it's bad. I mean, it's a legitimate expense that we can take. But sometimes our vehicle expenses, we work with a lot of our clients have, rentals and real estate properties as well. So the other thing we have to consider is if your business portfolio or whatever you want to call that extends outside of your practice, there could be cases where maybe you're using your vehicle for use in the practice. Maybe you have a rental property, so you're using that vehicle to run around and check on the rental property and got to do repairs and maintenance. So one vehicle could kind of extend over multiple different schedules on your tax return, and that's where usually it's just easier to do the standard mileage rate. You can keep track of those miles, or we've said that they have the apps and everything that'll help us keep track of that. And even if you don't have an app, I mean, the simplest form is just pull up a spreadsheet, and maybe once a week or once a month or once a quarter, I mean, at least once a year, go in there and create your mileage log. And the mileage log doesn't have to be complicated. I mean, you're literally just putting dates, why did you make this trip and how many miles was it? So you can keep it pretty simple. But if you do that one thing and just at least have a record of it, then if it does come under audit and the IRS does want us to substantiate it, which means they're going to call us out and say, prove this is a legitimate business expense, or else we're going to disallow it. Then at that point, we can hand this stuff over to them. And the reason why they love to go after vehicles is because for an IRS agent, it's just low-hanging fruit. A lot of times, 90% of the people, they just aren't keeping the mileage logs. They aren't, doing what they're supposed to be doing to actually substantiate the expense. And so it's an easy one for them to come after.
Yeah. Yeah, that definitely makes sense. Sometimes it's just what is the common sense answer? And you've got one vehicle, it's clearly not 100% business use. I mean, it's just kind of my own thinking. I'm not the tax professional, and there are other ways, kind of like the mileage. Like you said, the mileage is still a way to benefit from your business use of the vehicle without having to jump through some of these hoops. And Kevin, appreciate you going through some of those basics on depreciation. You talked about 2 ways to sort of accelerate that depreciation into a current year, Section 179, which has that 50% minimum bonus depreciation, which is at 60% and decreases over the next few years. And then just the regular depreciation schedule, which I think is 5 years, right?
Yes. It's over 5 years life.
And how does the size or type of vehicle play into it? You hear a lot about getting, the G-Wagon or large Escalade or something, 6,000 pounds or more versus less. Like how does that play into it?
Yeah, it depends on the type of car. Car depreciation has its own section of rule, additional rule that need to be followed. So, they divide it into passenger auto, and that is, the gross weight is under 6,000 pounds. And then they also have truck and van, so it weighs 6,000 pounds or more. So they use the gross weight to kind of divide out the class between luxury auto and trucks and vans. And because of that, let's say if you buy like a luxurious car and you want to depreciate, obviously in for the math, I assume that this is 100 years for the business. You thought that you can, if you take like 179, you can write out like 100,000 of depreciation, but that's not true. There are also limit on that. On each year, how much you can take depends on the gross weight limit. So I believe like for the gross for the passenger auto, the first year depreciation limit is $20,400, and then it's spread out to the second year, the third year, and all the years after that. And so keep that in mind when it's time to buy the car.
The other thing to consider too with depreciation is if you are going to purchase a vehicle for your practice, and again, sometimes we scare people. I mean, it is a legitimate thing. You can do it and not run into any issues as long as, and that's why Kevin and I are here. That's why we created Refractional CFO, is really just, if we're going to do it, let's do it right. Let's make sure the I's are dotted, the T's are crossed. And then that way we just don't have to worry about it. And just worry that let's just wait until statute of limitations is run out. So we shouldn't have to be worried about it every single year if we just do it right to begin with. But one note on depreciation, this is going back to if you purchase a vehicle, kind of think about how long you're going to have it. If you're just thinking you're going to purchase this for a high taxable income year so that you can, write off a whole bunch of expenses and lower your tax liability, and then your thought is you're just going to sell it the next year, what the IRS does is when we take that, so say in Kevin's example, we depreciate $50,000 worth of the vehicle in year one. Well, then if we go to sell that vehicle in year two, because depreciation is considered an ordinary operating expense, in the practice, in year two, when we sell that, now we have to recapture that depreciation, which is essentially kind of like, in the simplest terms, like adding $50,000 worth of income back to your return in year two. So some people don't realize that, and they sell it in year two, and then they're like, well, why is my tax bill so high? That's like, well, because you took this expense in year one, had to recapture in year two, and now you don't get that benefit. Plus, it's hurting you a little bit.
This was actually going to be my next question: is what if you need to get the vehicle out of the practice? You're going to buy a new one. You want to give it to one of your kids. How does that work? And especially if it's an S corporation, if you are distributing it out of the practice, it's considered a sale. Is that correct?
Right. That's exactly. So, anytime you distribute it out of the practice, you have to distribute it out as the fair market value of the car. And so that could cause some problem with the car being in an S corporation.
Got it. And so that depreciation recapture is something to think about, right? You get the benefit of that depreciation. You go to sell it, you get that depreciation recaptured up to a certain tax rate. You have to pay taxes on that.
And I mean, in your example, it's even worse when you distribute out the car, right? Because it's a deemed sale as the fair market value, even though you didn't really receive any cash.
Right.
You just take the car out. Now you pay tax.
Right. You give it, or your corporation gifts it to your child, or however, switch titling, however that works. You don't get cash in return, right? Your kid's not paying you for it, but you have that deemed sale. You have that amount in your tax return. For the most part, you might see the sale value lower than you originally purchased it. So maybe you're not having to pay it on the full amount, if I'm understanding that correctly, but not exciting, right? That's definitely not a surprise that you want to see at tax time when you're looking at your tax return and seeing what's going on.
I would just add to it that, a lot of times that's why sometimes we will kind of push people into maybe just tracking their miles and doing it that way, is because a lot of times Kevin and I, we're thinking through, here's maybe 2 or 3 scenarios down the road that could potentially negatively impact you. And sometimes when we're working with the practice owner, I mean, they're really focused on this year, which is great. And so sometimes there is maybe that disconnect, where we're thinking 5 years down the road and they're thinking, in year one. And so that's why it's good. It's healthy to have kind of conversations around this. Our goal is just hopefully to ask those questions so that we can understand, is this a vehicle that you're, maybe you've had your practice for a year, you're hoping to have this practice the next 30 years. And we want to get a vehicle in there. So that way, as you're doing work related stuff, you've got the practice vehicle for it. You don't have to use your personal vehicle to do that. And so as we talk through those scenarios, just get a better understanding of, because again, everybody's situation is unique and individual to themselves. And so, is you either, maybe you're one of our clients, maybe you're working with a CPA or you're working with a tax professional, make sure that you explain to them not only the purpose of buying the vehicle for this year, but what your plans are down the road. And that'll kind of help them better guide you as well.
Yeah, I think that's great. And The mileage definitely seems like the simpler option. You don't have to deal with that depreciation recapture. In terms of just sort of a general thought, in terms of depreciation, there are ways that we've talked about to sort of accelerate much of that into a current tax year, or you can sort of take it on the standard schedule over a certain amount of years, talking about, well, should you accelerate it? Should you more align the depreciation with the actual cash flow, especially if you're borrowing to buy the car? Do you have any general ways of thinking about that, whether to accelerate, whether to just take it over a standard schedule? What are your thoughts on that?
Yeah. So, most of the time, the tax structure for most of the businesses, they are LC, filing tax as S corporation. So even if they take the depreciation, it's the reduction of the income, but that income is being passed down to their personal tax return, right? And on a regular schedule, you depreciate the same amount over 5 years, right? On an accelerated schedule, you normally depreciate more at the beginning and less at the end, right? So you really have to take a look at what the income in current year versus the income in the future, right? Let's say if I make less of an income this year and my higher tax bracket is 15%. Maybe I don't want to take that accelerated depreciation. If next year my income is way higher and, in the future, I may have my highest tax rate is 37% for federal tax, right? So, I mean, it's, you rather to take that reduction now at the 10% tax rate, 15% tax rate benefit, or you want to take that reduction in the future when your tax rate is 37%, right? That the higher the saving in the future is. So it's more of a tax strategy and planning. Like if you own a practice and you already have plenty of depreciation from equipment from in the current year, or if you just barely have a renovation, you already have plenty of depreciation, and now your tax rate is 10-15% and you're in a good zone. I don't think you should accelerate, right? Maybe save some of those depreciation next year when you don't have any bonus depreciation or any 179 from equipment or build out, and take more of the depreciation in the next year. It's all about planning, and we as accountants like to help our client with that all the time. I mean, we got those questions all the time, and that's why the annual tax planning or quarterly tax planning, they're pretty crucial.
It can be an issue. We've got too many expenses in the practice this year, and so to fully take advantage of maybe on your individual return, the standard deduction, some of these other things, it might make sense to let's hold off on some of these expenses and push those into future years. And the nice thing is, with depreciation in the way that IRS allows us to do it, is we can pick and choose. So they have their default method. We can elect to do more of what's called a straight line method, spread that evenly throughout the year. So there's definitely finding opportunities around these different scenarios.
It sounds like it just comes down to the projections and planning, looking over the next couple of years, thinking about how long you're going to keep it. And we're kind of in an interesting time now where we've got a tax law, much of which is going to sunset over the next couple of years. So large parts of this Tax Cuts and Jobs Act 2026 tax year and beyond are going to revert back to prior tax laws. We've got QBI deduction that's currently present that may not be, I don't know, we don't know, but is currently set to not be 2026 and beyond. So we're kind of in a transition period too. So I think it makes a lot of sense to talk with your professionals, talk with your tax professional, project out the next couple of years and see what the numbers look like, knowing that transition period is going to happen. Or you might be in a place where you're phasing out of QBI or some other deduction or credit, and that accelerated depreciation may help you phase back into it. So it's a great opportunity to talk with your tax professionals and think about more of that long-term planning, even outside of just this tax year. And there are some other non-financial considerations to keep in mind. Something that I think about, number one, is liability and insurance. And I don't even have all of the answers to this sort of thing to think about. But if it is a business-owned vehicle and your kids are driving it, are there liability issues if they get in a car accident, if you're an older doctor, you've got teenagers that are taking it. Are there liability concerns, insurance concerns? If it's owned by the business, it needs to be insured under a commercial policy. Talking with a broker before this call, those commercial policies are going to be more expensive because it's assumed that it's taking on more risk under the policy. And you need to make sure that if your kids are taking it, you need to make sure you have all of the drivers as named drivers. You don't want to forget any of that. So there's these non-tax considerations that you want to keep in mind. Financial costs. So if you are buying a large vehicle over 6,000 pounds, just for the tax benefit, you're going to be buying a more expensive vehicle. It's going to be a cash hog over the years. So you're going to be paying more over time for that. And it's important to say this is all for a deduction, meaning you have to buy the vehicle in full. You have to pay the full price for it. If you're borrowing, you need to pay the interest on that borrowing just to get a deduction on a certain percentage of that value. So you need to make sure that this is something that makes sense for your family, for your driving use, for whatever you're going to be using that vehicle for. Any other final thoughts on this very exciting topic of cars in the practice and depreciation and all that?
Oh, you got my wheel spinning there a little bit, and I feel like this would be a whole other podcast topic. But just what happens if your kids who are also of driving age are also employees and working in your practice, and how does it implicate things? So, definitely lots of things to consider. We're at the tail end of 2024. You're going into fourth quarter. If you're finding yourselves looking at your financial statements, wondering about these things, now's the time to have those conversations with your CPA. Don't wait until December 31st. I'm at the car dealership and I'm wondering, should I buy the car? Should I not? I mean, that is not the best time to ask your CPA if you should be purchasing a vehicle or not. Just know we've got 3 more months to kind of work through these things. The other thing too, interesting with 2024 is it's an election year. So as we look at some of these tax legislation that's going to be sunsetting and expire, we could be working with a whole different set of rules next year. So we try and operate the best we can with what we know. I mean, we have been in instances where we get into the next year and they made stuff retroactive. Hopefully that's not the case, because that's always a headache. But just know we know now as we get into the next years, and probably just because this podcast kind of lives on the internet forever. If you're listening to this in 2025 and things have changed, just know reach out to your professional.
Yeah, exactly. Imagine if maybe this comparison will be kind of understandable for all the listener here. If you go to a doctor and ask for a diagnostics, each doctor would give perhaps a slightly different version of the diagnostics or the medication that a patient need to have. Similarly, I mean, the tax code, the U.S. tax code is pretty complicated. Each person situation is also different, and that creates some complexity here. So the advice here, consider it as general advices, but please talk to an CPA of when to buy a car, how to structure that, how to put it into the business, what method of expenses or depreciation you should take. It's vary from different businesses. I mean, just in my hand right here, I have this playbook of depreciation, and just on the topic of depreciation, for clarification of the tax code, I have probably about 500 to 600 pages, and believe it or not, this thing is called Quick Finder.
500-page Quick Finder shortcut book, huh?
Yep.
Yeah, 500 pages of depreciation and code, and that is already quick. So from time to time, the depreciation of cars using can be pretty complicated.
Yeah. And I appreciate both of you coming on and bringing, as tax professionals, the reality of the situation, both in terms of how to do it appropriately, but also in terms of the actual audit risk, that businesses face. May that change over time, sure, but you bring the reality to that. So listen to Jackson and Kevin, go talk with your own tax professionals and see what is appropriate for your specific situation based on your circumstances. And with that, I appreciate both of your time. Where can people find you and follow you and learn more about what you're doing?
Yeah, I mean, probably the best way. So our website, refractionalcfo.com. If you ever want to hop on a quick 15-minute call for us, with us, or if you have a question, you can go there. There's a big button. You click on it. It takes you to a calendar. You can schedule a 15-minute call with us. And that's probably the easiest way to talk to us.
Perfect. We'll throw all of that in the show notes, as well as past episodes we've done together. So I'll add those into the show notes too. If you have questions, reach out to Jackson, Kevin. And in the meantime, we will catch you all on the next episode. Take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.